Hey everybody, John Gibson, EVP of Sales for TPO over here at Flagstar. Welcome to our May Flagstar Flex event. I think it's our 12th one in the series that we started during the pandemic, with the goal and true intent of just giving you some content and some education and insight into things that are important to you as the market continues to ever change. And you'll see we have some pretty good guest speakers today because markets change us on a little bit. Want to apologize in advance. We're doing this live, so working at home, pandemic, you know how that goes. There's some landscapers at the house next door that are making some noise, and I can't control that, so I apologize if it gets loud. But hey, as always, hopefully everybody's doing good. You're safe, you're healthy. In regards to kind of pandemic, I know, it doesn't get talked about as much anymore, but people still be safe, right? I mean, people are still getting diagnosed with COVID and different strains. So hopefully everybody's doing good and safe. And then, hey, I want to get into this a month session, right? We have two presenters. I'm going to introduce them, bring them on stage, and then we'll kind of get into kind of some of their thoughts on what they're seeing. Because I do think really what we want to look at in this session, right, is a lot has happened since January to now. Regards to kind of the housing market, inflation, things overseas. Obviously, there's some I guess you would call it a war, right, overseas, that are impacting a lot of things in relation to the economy, rates, and what we do for a living. So we're going to talk about that. I think our two presenters will have some good insights on some trends that we're seeing now and potentially into the future. And what should you be looking at in a rising rate environment, right? Because that's the reality where we are today. And for a lot of people in this industry, they've never been through this cycle before, right? They've been a loan officer in their jobs, and all they've ever seen is historically low interest rates. So we're going to talk about that. And then I think you'll hear some insight in regards to like capital markets, secondary, what we should be thinking about and looking to do and implement as we move forward. So with that being said, I want to introduce our two presenters, or our two guest speakers. One is from Flagstar. His name's Jason Lee. He's been on our Flex series before. Jason is the EVP of Secondary Marketing at Flagstar. He is our Executive Vice President. He heads up secondary and capital markets for us. And he's responsible for all secondary marketing activities, including trading, hedging, marketing of residential-backed securities, pricing, margin management, loan delivery, you name it, everything within inside of secondary capital markets kind of functionality reports up to Jason. And I've actually known and worked with Jason for going on probably 15 years now. So use him for a lot of resources and a lot of knowledge for what we give to our partners. And I'm excited that Jason was able to work with Brandonn, who is a CFA EVP of Real Estate and Consumer Lending over at Curinos. He's been in his leadership role for a while now. He's responsible for the development of new business tools and services to enhance their clients' ability to achieve their margin, their share, risk, and operational objectives. And before joining Curinos, he worked with Informer, FBX, previously Icon Advisory Group, where you may have known that name versus Informa FBX. Throughout his 20 plus years in the finance industry, he's provided strategic direction for such companies as Capital One, NationStar, Bank of America, to name a few. So I'm really excited to have these two guys on, and let's get into it. So why don't we bring Jason and Brandonn on? Hey, what's going on, guys? How you doing?
Hey, John.
Doing well, thanks.
Good to see you, Jason. Brandonn, thanks for joining us. I appreciate it. Sorry for a little of our technology challenges here on our live event, but hey, that's what happens when we're live, right?
We're good. We're here.
So I know you guys got some stuff you want to go over, and really, I know you kind of probably heard the intro on what we've been marketing, but thoughts on just at the high level, and I guess, Jason, I'll start with you, what we're seeing in such a quick time period as this year, as the calendar turned and we went into 2022.
Yeah, sure. So I think, we'll get into some of these slides here too, but the market's moving so fast at such a velocity that we haven't really seen since, the Reagan era, right? So early 80s, going back, 40 years to see this kind of movement. So from 12/31 till the end of April, we shot up to 5% on a 30-year fix. So a lot of change happening rapidly. Not very many people thought this would happen this fast, at this pace. And so looking at this, we threw this together here. This is done by one of our guys on the margin management team who leads up retail, Peter Goldstein. But, the experts, even the experts are getting it wrong. So if you look at the quotes here, going back to last year, mid last year, no hikes, at least through 2023. Well, we know that's not true, right? Tapering bond buying soon. Well, that didn't happen, right? So I think it's fair to say that top left corner there, everybody's got a plan to get punched in the face, right? So the market can stay much more irrational than you can stay liquid, and you just got to stay, on top of what's happening here with the rates. I got a buddy that says lock early, lock often, right? Take the risk off the table and get those loans locked in. But we're in a period of such uncertainty that we really haven't seen in this century, really.
Yeah. Hey, Brandon, I do like the one up top left, right? Everyone's got to play until they get punched in the face. I mean, I think, what are you seeing from your perspective, right? Because I know, like, for us, right, we budgeted for this type of market that we're in to be more of like a fourth quarter event, right? And you fast forward it to first quarter. So thoughts on what you're seeing as well?
No, Jason hit the nail on the head. We haven't seen this in some time, although it is a very cyclical business. To have this kind of volatility is putting a lot of people who are new to the industry on their back foot a bit. It is kind of interesting, though, to even know that, this was slightly anticipated that rates were going to go up, just not at this velocity. But everybody still went into the year very gung-ho, very aggressive, grow share, grow volume in an environment like this. Not quite sure what everybody was looking at when they made all those plans. We knew it was going to be tougher. Just not so swiftly. So I think it has taken people by surprise. And so in the space that we're in and in the visibility that we have to the data, you see where margin compression is happening. You see where people are trying to be a bit more aggressive and a bit more out there from a margin perspective to just squeeze that down to try to keep as much volume coming in as possible before they have to shift some of their business model and some of their plans.
Well, and I think, Jason, that kind of leads into this slide, right? Which is, again, I think if you look at MBA, Fannie, Freddie, they tend to be the benchmarks, right, from an industry perspective on, forecast around overall size of the market, mix, things like that. Obviously, I think leading into the year, everybody was forecasting, to your point, Brandon, that at some points rates were going to be going up, maybe not this swiftly. And that refis would be a smaller percentage of the overall pie when you look back at 2022 in hindsight. But obviously, we're seeing a dramatic shift in that. So, Jason, I know you had some thoughts around kind of the refi market, cash out, and things like that.
Yeah. So I think to Brandon's earlier point there, we all were planning as we were budgeting in August and September last year for 2022, right? That we knew the purchase business was going to be one of the main drivers. We just didn't know it would be maybe the only driver. But cash out is still out there, right? So there's still life events that, for whatever reason, even if somebody's in a low rate, they need to consolidate debt, put themselves in a better position, get credit cards paid off, whatever the case is. But we're seeing that, and this is actually Curinos's data, but we're seeing the rise of cash out, back into, call it, almost the 80-20 rule, right? Almost 80% of all refis are cash out now. And that's, we're showing our mix there as well. That's all of Flagstar, not just TPO, but we're tracking towards the market there, and the market's, that's showing that it's just evaporated, right? So the folks that could refi for a rate and term, for whatever reason, they didn't, either just were living under a rock or didn't want to be bothered with it. They're kind of out of luck now, right? So that graph on the right there really demonstrates that in a pretty eye-opening way, right? The amount of mortgages that had in the money ability to refi, so say there were 50 basis points in the money, 50 basis point improvement in their current rate, has gone from over 80% of the market to relatively basically zero, right? It really is the folks that, for whatever reason, just don't want to refi or can't refi. So I don't know if Brandon, if you have more to add to that, but that's a pretty stark contrast to what we've lived the last couple of years.
Having been in a previous life in your seat and responsible for trying to get a servicing portfolio to refinance, there are individuals that simply do not want to. I think possibly a little bit of a misunderstanding as far as term. Hey, I've only got X number of years. I don't want to extend anything. I don't want anything to change. So there are always going to be those individuals that choose not to take the win. But the same type of thing where you've got a servicing book out there that no one's going to be in the money. This extended period of an extremely low rate environment, think about it now, rates are going to have to go down a couple hundred basis points to get a significant component of your servicing book back into the money from a rate term perspective. But from a cash out, it's always going to be necessary, and we'll get a bit more of that in a bit.
Well, and I think, Jason, that slide on the right, it shows the rapid trail off, right? Like we didn't ease into this. You look at like January forward, it's been continuing to decline even before that. But with the significant rise in rates, you're seeing a tremendous drop off. I mean, I think we had a stat the other day, I think month to date at our shop, right? I think it was 88% of the refi locks that we've taken this month are cash out, right? And it's less than 10% of the overall lock volume. So it's real and it's here. But I think there's some good things we're going to talk about, right? If you're a business partner on the other end of this, doom and gloom isn't necessarily how you should be looking at it. There's opportunities and advantages in this marketplace as well. So
That's right.
I know you had some stuff on the next slide we were going to go through too, so we'll pull that up.
Yeah, so this is, we're kind of going back to the first slide. Everybody has their opinion of what's going to happen with rates, where we're at. And the key thing to remember here is the bond market's always one step ahead of what the Fed's going to do, right? So they're anticipating things to happen. So will there be another two moves up 50 basis points each, right, from the Fed, or will it be 75? So the bond market's pretty efficiently adjusting to that ahead of time. And this really kind of shows you in a very easy to understand fashion, especially for me. I can see it right here, right? So that red line is your Fed funds effective rate. And we've basically been at zero since the pandemic hit, right? And the blue line is your 30-year fixed mortgage rate. And so you can see that the market's already anticipating what's coming, right? You couldn't have a better crystal ball of what's going to happen here. And will that come back down a little bit here as things start to change? Like, Powell came out and said, hey, we're gonna do 50 instead of 75 moving forward, right? So we had a couple of days of rally of pullback in the mortgages, and that was a direct effect of the mortgage investors overshooting what they thought the Fed would do, right? And so we'll continue to see that happen, but just to know that we're always one step ahead a bit of what's going to happen based on the speeches or the indications that we're getting from the Fed.
And I think what you don't see here is the impact of the margin compression. If you look at the primary secondary spread over the last several months and how it has slowly come back to what is really a historical norm, pre-pandemic historical norm. So that increase in the rate would actually be higher if lenders weren't out there reducing margin.
That's a good point. Yeah, I mean, we could be sitting at a whole different rate stack.
Yep.
Well, I think the interesting thing, and I'd ask either one of you too, to that kind of tail end of what we were just talking about on compression, primary, secondary spreads is, obviously you look at the last 2 years, right? 4 trillion, 4.1 trillion. People were, more forecasting for 2.8. So there was this rush to build capacity, right? So everybody had to build capacity to get to that 4.1 trillion. Now the predictions, you're looking at roughly 1.6, 1.7, 1.8 trillion coming out of the market. You're starting to see that in the industry. Like you mentioned, Brandon, everything's cyclical, right? Mm-hmm. Overcapacity, pulling that out. Unfortunately, that tends to be headcount, right? Let's call it what it is. It's expense management. At some point, it tends to be headcount. So you're starting to see that happen through the industry. And then the question I would have for you is, do you do you think at some point in the future, as that capacity comes out, less refi, all purchase, do you think there's an opportunity for, instead of margin compression, do you think you'll see the reverse of that, where margin may come back slightly from a standpoint of, kind of right sizing and then competing in that market that we'd be competing in?
I've actually been pleasantly surprised the margin compression has not been as swift. It's come down quite a bit, but like I said, it still hasn't gotten back to what I would call the pre-pandemic levels from a margin perspective when you look at that primary secondary spread.
Yep.
So there is some resistance because flat out that additional capacity has an expense associated with it. And if you're just looking at a simple cost model, you can only go so low. So trying to get the benefit of, seeing some expense reduction that will probably follow, then you're going to see that a bit in the margin compression. It will continue to go down, but it's going to have to be accompanied by, unfortunately, to your point, some impact to the industry.
Yeah, I think like you were seeing it every day, right? In the publications, and I don't think at some point, unfortunately, I don't think that's going to be a company that stands out where they're not going to have to focus on that. Okay, so I know, Brandon, you have some things that you were going to share with us from your perspective, which we'll kind of pull up coming up. But anything else, Jason, from your perspective? I like the idea of lock early and lock often, right? But like anything else from that standpoint with the volatility that we're seeing?
I just kind of go back to the point you guys were just discussing there. To me, to try to like visualize how we, it's a manufacturing plant, right? I mean, not to minimize what we do, but being from Detroit and from Michigan, I think about if you're only making, if there's a demand for so many millions of cars, and all of a sudden that goes away by 40%, you've got all these people that were building cars, and there's nothing for them to do anymore, right? And so I think that's what we're all struggling with, as an industry here, is where's that going to stop? Where's that number, right? Is it 2.5? Is it 2.6?
Right.
So you're talking 40% of the market is evaporated in a year or 5 months. And that's really where, some folks are trying to hang out, right? Well, what if we get a bounce? What if something were to happen? What if, this Russia thing really starts to escalate and rates drop again? I'm going to want that capacity. So I'm willing to kind of ride it out a little bit and see what kind of happens into the summer here, and see if we do get a bounce, then I'm going to be ready to go. So I think we still have some guys in limbo that aren't fully bought into that rates might not come back down.
Yeah, and I think you hit on some good points, right? There is always that we've built the capacity. How do you get to that sweet spot, right? To build some upside into the forecast or the capacity model, right? In case rates do tick back down. Because let's face it, and we'll probably talk about this in Brandon's section, I know, or we can talk about it afterwards, but there is a school of thought that if the Fed acts appropriately and gets as aggressive as they should, you could actually see from history that rates could level out and start to come back down at some point based off of all the moves that they're going to make to try to curb inflation. So this could be a short-term lived thing, depending on how quickly and how fast and aggressively they actually really act. But to your original point, who knows, right? Like predicting this type of stuff is, you've got a better shot going and putting, your money on black or red at the roulette table, I think, in some cases. Yeah,
and I think some shops are willing to ride it out a little bit to see how it goes, right?
That's right.
It's a lot easier to stay in shape than to get in shape, right? So it's easy.
That's right. Before you get into this slide, what were you going to say there?
But I think that's really the point. Is I think we're still in flux, and don't forget we're coming up into another election year with presidential election in a year, right? So
that's right.
You know what happens when that usually rates drop. So
that's right.
There's just a lot of moving parts here, more than usual.
No, I think the conflict happening in Ukraine is absolutely influenced some of the decisions to maintain capacity, just the unknown. Mm-hmm. They don't want to be left out having reduced capacity and then having to ramp it back up if something happened dramatically to change the direction of where rates are going and where they are now. So I think there is probably some delayed reaction that's taking place, but Since my slider's pulled up, I can get into a bit of this. Jason had been talking to, the demand for cash out and the influence that, cash out has on the total refinance market, up to 80% of all refinances in the cash out space. And what we're seeing, and sometimes we like to isolate the particular subset of the market, like Flagstar, that does both cash out and home equity as a product set, and how all of that is impacted by what had been going on. And looking here at the cash out rates had been below for the entire length of the pandemic, any home equity line. And we saw a significant reduction in home equity demand, not just within the subset of the consortium that we cover, but just across the entire market, where cash out itself had some increased popularity, obviously throughout. That's shifting. That's changing, where cash out rates have followed the rest of the mortgage rates up, and now are above, if not significantly higher than what you can get in a home equity space. As we'll see on the next slide, the home equity rates have remained flat pretty much throughout the pandemic. It ticked down a little bit here recently, and then are coming up slightly. But you're seeing a pretty significant shift in the home equity capacity, or the home equity volume, coming back to where it was prior to the pandemic. It was very suppressed during the pandemic. Several major players just simply exited the home equity space, moved all that capacity over to first mortgage. We're seeing some lenders move that first mortgage capacity back to the home equity side.
Well, and look, I think that flows right in what we're seeing, right? From a daily business flow between cash outs being a little bit more of the mix. And then obviously, as you mentioned, one of the things we're getting ready to launch at Flagstar is our HELOC, standalone HELOC option for our business partners, which is coming here probably in the next 30 days. So, kind of looking at it from all aspects of what is the borrower consumers need and how do you satisfy that moving forward. We want to make sure our business partners have an outlet for that. But you were mentioning the next slide, kind of showing around the home equity versus benchmark. So what are you seeing here?
Obviously, you can see the suppressed volume. There was an initial shock when the pandemic first started. A lot of people applied and got extended lines to have as a rainy day fund.
Sure.
So right at the beginning of the pandemic, you did see a shoot up on that side, but just suppressed volume. All of this volume historically low on the home equity side, but starting to see that rebound significantly. It just, the pivot between first mortgage cash out rates and home equity rates having already flipped, is you're going to see a lot more people taking advantage of the opportunity to just get into a home equity loan where they're not replacing the first mortgage that they already have. Given that the significant rate, I think it was around 3.5, 3.75 on the cash out rate, where it became better to get a 4.5 home equity line instead of trying to refinance the entire mortgage. So since we've already passed through that, we should see the home equity demand, at least for tappable equity and cash, continue to increase.
I mean, I think that's the key, right? Like, if I were a business partner looking at this, it's optionality, right? When you're staying in touch with your borrowers, we always try to tell them, you're their financial advisor when it comes to the mortgages for life, right? If you're doing it right, you're staying in contact with them. Mm-hmm. Well, the mortgage checkup today for a client that you did a loan for a year or 2 years ago is a much different conversation than it was even 5 months ago, right? In regards to somebody at 2 3/4, 3.25%, you're reaching out to them to stay in touch. What's the value that you bring moving forward? And you, as the business partner, being able to have options around a HELOC is something that you're solving a customer's need. Because to your point, there's kind of that break even and beyond, right? Once you cross that threshold, now it makes more sense financially to go in the path of a HELOC. And I think that's what you're saying.
Mm-hmm. We are.
Jason, any thoughts around that?
Yeah, no, I think you've got a period of time where there was a lot of wealth creation, right? Not just in home values, but in the stock market. So I think you're seeing, I think the trend makes sense. I think the panic move in March, I think John, you and I personally talked about, should we go get HELOCs right now?
That's right. That's right.
I remember that conversation, like at least to have it, for a rainy day, because life happens, right? We never know what's around the corner. So I think that folks are starting to see that, and as Brandon said, with the rates so low on the first, it makes a lot of sense.
With that panic move that you just talked about, what we also saw was just really low utilization.
Yeah,
because ultimately it wasn't necessary. A lot of people didn't need it that went out and got them. So from a lender's perspective, that is also not great.
Right.
When you extend the line, you want them to utilize the line. And now with the draw period, we're seeing an extended draw period. We're starting to see draws happen a little later in the life cycle than traditionally they were used for, as people are starting to take advantage of the lines that they got before, right at the beginning of the pandemic.
So go ahead,
Jason.
We don't have to go back to the prior slide, but I guess I got a question, Brandon. So are you seeing, or do you feel there is a rise of HELOCs versus HELOCs, that folks are more comfortable with a fixed rate versus a line of credit that would float?
We are seeing a bit of a tick up in the percentage of HELOCs. Some of that has to do with the product availability. Some lenders just simply didn't offer them, and they've started to. I think you hit the nail on the head. People being more comfortable with fixed rate. We've had such a long period now of a low fixed rate environment for your first mortgage that some people are just simply more comfortable with that. Yeah. And that's a great transition into what we're going to be talking about next, seeing the increase in the ARM space. And a lot of that is obviously driven by affordability and what you can put on there, with the fixed rates being significantly higher now. That we show just in the conforming space hasn't necessarily taken off like the non-conforming space, which we'll look at next. But it's up 70% just this year. So we're seeing a slow increase in the percentage of all conforming loan balances come in, up to 4.25% of the space. It's people are becoming more familiar with it, more aware. We talk about this being a purchase market, using it as a purchase activity to get into that bigger house, get into that more affordability. The increase in home prices, something we haven't really touched on too much during this conversation, has driven some people out of that fixed rate space to get them down to on the purchase side a conforming ARM loan to just make it more affordable. Right.
And I think that first time, it's scary when you're a first time home buyer, and it's even scarier when you're trying to figure out how mortgages work, and then to get an arm thrown at you at the same time. It's a little difficult to digest, but from an affordability standpoint, that first time home buyer, they may or may not stay in that house 3 to 5 years. So it does make sense to go with an ARM, because there could be, household formation, having children, needing more space. So I think there's a lot to that. It's interesting because it's 70% increase, but it's still only 4% of the market, right? So it's getting there. Traditionally, it's hard to say traditionally to go backwards, but what is it traditionally? Do you have a feel for that? Maybe 10%, 15%?
I was about to say it floated between around 10 to 12%.
Yeah.
Traditionally, and you'd have to go back to, I don't necessarily look at what we went through in the aughts as a good barometer for the ARM space with the subprime and non-prime. But traditionally, in a let's call it a stable environment, it's about 10 to 12%. But you also had you had the curve that supported it.
That's right.
Well, that was going to be my question, Jason. We've talked about that a lot, right?
Yeah.
Talk to that to kind of, because we hear a lot from our customers, right? Business partners that are watching that is, hey, fixed rates have shot up so much. The ones who do know about ARMs that have been doing this for a while and have maybe, done ARM production in the past, I think they're shocked to understand that there's still not that much variability between the fixed rate and a conforming ARM. Can you guys talk to why that is to educate people?
Yeah, or none, right? So
right.
The kind of going back to what I showed earlier, how we kind of front run what we think is going to happen, right? So the long-term rates are already playing against, like, okay, well, we think the short-term rates are going to go up. And so what's happened was the Fed's raising rates. They're tilting that low end of the curve, right? And we're just flat again. I mean, at one point we were actually inverted.
That's right.
But the way that Fannie and Freddie ARMs get priced is a spread to treasuries. And so, you pick your point on the curve, wherever that's at, say 3 years versus a 30-year fixed at 5 or 6 years. Those 2 points are about the exact same yield, right? And so there's really no benefit right now at all as far as Fannie and Freddie are concerned anyways, selling loans to them. There are some smaller shops out there, a few banks that are buying here and there, but not in mass quantities or any kind of meaningful volume. I think this is, we do see some credit unions out there doing some kind of wild stuff, but that will pass shortly. That's they come and go, depending on what happens in the market. The credit unions seem to have a month or two of a heyday, and then they'll pull back, right? So it will come. It's just a matter of time once this yield curve kind of sorts itself out. So that's where we're at right now. We do get a lot of questions about it, a lot of emails, and it's just not there right now.
Well, and I think Brandon, a good segue into your next slide, right, is more of the non-conforming space, because that's where I think we are seeing a significant shift. So your next slide kind of goes into that. So I'll have you talk about that.
No, absolutely. The non-conforming space has always been heavier on the ARM. It's a portfolio product, and people keep it on their balance sheet. That allows them to have more flexibility in how they position it, and how they price it, and how they pitch it. But you see here that even this year, a significant increase in all available non-conforming production, 22% at the beginning of the year, up to 38%, 37% in the most recent weeks. That's a significant change, but it's also incremental when you look at the benefits to the borrower on a larger loan. You're going to see that benefit increase from $1 savings per month that somebody's paying. It's also a lot more prevalent for that to be an IO production, where somebody's only paying interest and keeping a payment as low as possible, or making that decision that Jason just mentioned before. How long am I going to be in this house? How long am I going to be here? How long do I even want this loan for? So seeing that in the numbers has been pretty telling over the last several months, watching that increase dramatically.
Yeah, and the interesting thing, Jason, this, right? We've seen that same type of trajectory at Flagstar with our HFI product, right? Our portfolio product. We've seen a sizable growth in that since probably about middle of March, if I remember correctly. But we've seen that same thing on our end, Jason.
Yeah, it's really taken off on the TPO side for us, including wholesale, right? So we're a buyer for portfolio on the jumbo ARMs, and we like the asset, and we'll continue to buy there.
Well, and I think one thing to talk about too, and maybe some people on this watching this will laugh, but again, there are originators in this space that have never been in an environment less than a 3.5% fixed rate or lower, right, in their entire career,
right,
and they've never sold an ARM, ever, right? So, but to your guys' point earlier, I know Brandon, you were kind of saying back in the heyday, right? You can go back to the whole negam, the whole, no income, no asset, fog and mirror type of stuff. I think it's important for everybody to know, and it'll be a good segue at the end. These aren't your ARMs from 10, 15, 20 years ago. There are between, the QM portion of it, ability to repay, you start rattling everything off. The ARMs that I think, people looked at in the past as maybe part of the reason why we got ourselves in a position we're in, they just don't exist today. There's so many safety features. It's
funny that you say that, you can go back to, and my first thought was, I never want to go back to, that again. But the production that's taking place now in the ARM space is nothing like it was then. These are good borrowers. They've got good positions. They're making smart decisions by going into an ARM and going into what they know they can afford. And this product helps them do just that.
Right. All right, so I got some questions for you guys that have come in. And I guess we can pull the slide off and just bring everybody up. So a couple questions just in around topics market wise. First thing was, one of you touched on kind of affordability, maybe home price appreciation. So Brandon, I'll go to you first. What are you seeing trend wise in regards to appreciation going forward?
Appreciation continues to be a significant player in what people can afford. It's going to get exacerbated by the increase in rates. And ultimately, the two are going to collide. And we're going to have appreciation level off. I think that would be the assumption. In a traditional market, that would always have been the case. But what everybody keeps saying, the economists keep saying, this isn't a traditional market. There's a limited supply out there.
That's right.
And so that appreciation is going to be tempered somewhat, but it's still going to be real. And in markets where there's just not as many houses for sale as there is demand. I think what you do have is a play back to the home equity space and the play on people just staying where they are and expanding on what they have and what they do. It's not going to be a great fit for everyone. There are people that are still going to want to get into new homes. They're going to want to get into bigger homes or lifestyle changes, possibly going down as they see fit. But that environment where we have the limited home supply is going to continue to keep that appreciation pressure on, regardless of where rates go.
Are you seeing that in any, from a demographic perspective, any specific MSAs that may be getting hit harder with that, with what I reference is kind of the lack of supply? Or do you see that anywhere? I mean, obviously, we know there's a lack of inventory nationwide. But is there any area that you look at that kind of sticks out more than another?
Some of the things that I'm seeing actually aren't showing up in the data because there's a significant, and there's been articles written on this, and we talk to investors, but there's an investor play out there where corporations or funds are going in and buying entire neighborhoods.
That's right.
There's a builder in Texas that literally is building a neighborhood that's just for rent. And there's some markets like the Phoenix and Atlanta's that are having just an increase in the number of investor purchases that are coming in that aren't going through the mortgage process, and they're paying cash for these houses and then putting them back on the market as a single family rental. That's going to have pressure on the home price appreciation in addition to rental appreciation and how that impacts us all.
Hey, Jason, question came in regards to, we've talked about it in I think the flex that you and I did maybe 8 or 9 months ago, maybe 6 months ago, and they've seen it with us. But can you talk a little bit about RMBS market, where it sits today? Because obviously, I think last year that was something we participated in heavily, right? Because there was certainly an appetite for it. But it seems like that's somewhat cooled off. I think I know the logic behind it, but can you educate our
sure. Yeah. I think, in a shameless plug for Flagstar, I think, we do or have done a really good job of pivoting when there is a niche or something in the market and bringing that back to our partners, right? And so the RMBS market, when it was ripe, when Fannie Freddie pulled back due to FHFA constraints on investment properties, we became the largest issuer of non-owner occupied agency eligible product, right? We did 2 deals before anybody did one. We did the only 15-year deal ever done. So, and ironically, I'm wearing my RMBS team shirt today. So good call on that question. But yeah, so we stay in constant contact with investors, right? And when I say investors, it could be private equity, it's foreign countries, pension funds, states. The state of Michigan invests in our bonds. So if you think about the allocation of funds to invest on a yearly basis, if I'm getting my allocation of X amount of dollars this year, and I know, kind of going back to what we talked about already, I know rates are going to keep going up, right? So maybe I'm going to sit on the sidelines a little bit. I mean, if there's a good deal that comes along and I can buy at the price that I think is a good price or discount, I might deploy some capital. But for the most part, I'm going to kind of sit on the sidelines a little bit here and wait for maybe another Fed hike and see where this goes. So there's just no depth of liquidity. I mean, there's a price for anything out there, but it wouldn't make sense, right, to bring it to the market and for your lender partners, right? So
right.
We're really watching it. We talk to our partners all the time. We talk to our fellow investment bankers. It's a good community of us. We all want the private label securitization market to flourish. So we do talk a lot with, you name it on the Wall Street side of the coin, that issues as well. So I think it will come back. When, I don't know. It'll be just like everything else happens in our business. It'll be a Wednesday and I'll say, hey, John, we're turning jumbo back on and let's go.
That's right.
Or FHFA could come out again and say, hey, Q4, no more investment properties, right? So we're evolving as an industry. There's a lot of deferred maintenance on the Fannie Freddie side that I think Sandra Thompson's going to take care of, or start to move towards, especially the low to moderate income initiatives that she's working on, that could change the landscape of what Fannie and Freddie really truly buy. And that would push things more back to the private side, which we'd be ready for.
Well, it's interesting. I think both you and Brandon have talked about it throughout this session, right? But the visibility that we have into like direction, you talk about the bond market front running the Fed, the window, I think, of what we see as far as direction, path, and decisions that are being made. I don't know. I've been doing this for 25 years on the sales side. And it seems to be one of the most, opportune times that we can actually look into and see where we think things are really going to go versus forecast and guess.
Yeah, for sure. Yeah. I mean, I think the transparency, sometimes I think maybe the Fed's being a little too transparent, but yeah, I think, we've never had this kind of transparency, or, whatever you want to call it, a crystal ball. We just never had this like this before. So there's just a lot of information, just like everything else in your life, right? There's just a lot of information.
That's right.
And just, you got to be careful on what you read and what you take away from it. But everybody's got an opinion on both sides of what's going to happen here, and we'll fall in the middle somewhere, right?
Sure. Brandon, from your perspective, anything else you're following trend-wise that kind of sticks out to you, or something that you're tracking that would be of interest to our business partners?
I think Jason touched on it when he said, I pick up the phone, I'm going to turn jumbos back on. It's just more product development. You're going to continue to see some more creativity in that space, in the non-QM space. Some, depending on the lender, coming out with things that are best fit for their balance sheet. May not be a traditional 5, 7, 10, 1 arm, 10, 6 arm. So I think there are things that are starting to show up in the data where, you get these weeks where a brand new product shows up, that we hadn't seen in quite some time, or hadn't seen ever, that you're going to start to see pop up here and there.
Yeah, for sure. That's coming for sure.
I think that has to be coming, right? From a product expansion perspective, because let's face it, right? You got an overall shrinking market. You got rising rates, at least for the foreseeable future, from the window that we're looking into. So there has to be a breadth to fill need from a housing perspective, and that's going to come from product expansion, right?
Yeah.
This question's mine, Brandon. This didn't come from somebody. Well, I wanted to ask you this to see if you guys track this at all. So there's a lot of talk in regards to, kind of the channel makeup, right? How much is being done by retail? How much is being done by broker? How much is being done by correspondent? Obviously, we can see those. My question is more around we tend to hear that there's a migration that's taking place where we're seeing a lot more formation in the broker space, and it continuing to increase as far as the overall percentage of the mix, where you're seeing maybe retail loan officers come out and open up their own broker shop. Are you tracking that at all? Do you have any insight to that whatsoever from a statistical perspective?
So we, a little plug for Kiranos. We are a company that has a consortium of members. And so what we are tracking are the development of their retail, wholesale, and correspondent channels for our member lenders. And so if there are people going out there and they're starting their own brokerage or with firms that are not part of the consortium, we don't necessarily track to that, but there are other sources for, TPO volume versus retail volume. Just traditionally, there's opportunity for wholesale and correspondent at all times. It's just how you position that and where you want to put your investment. Because I think there's always going to be a chance to grow both those channels versus retail. And I think we're coming back into an environment where, how significant is the retail space going to be post-pandemic, and what that means, and how the relationships can be maintained when somebody does leave that retail position and go and start their own broker. And so we do have statistics on that. It hasn't shown up to be a significant curtailment quite yet on the retail side. But during the pandemic, we absolutely saw wholesale increase in importance throughout.
Yeah, for sure. Well, hey guys, look, I appreciate your time. Anything in kind of last thoughts you'd want to, I'll start with you, Brandon. Anything in last thoughts for the viewers in regards to kind of things to think about? Because I always laugh, right? Like, rates are going up, but if you look at it historically over like the last 40, 50 years, a 30-year fix was in that 7, 7.25, 7.5, 6 3/4 range, and we're still significantly below that.
I think Jason and I talked last week, and we had both mentioned our first mortgages had 7 handles on them when we bought our first houses back in probably the 90s. So I still look at this as an attractive market, to be honest. When you're going out there to buy your first house, it may not be the rate term play that we've had in the past, but it definitely still within the realm of affordability. It just ultimately depends on your appetite for, what percentage of your income you're going to put towards your housing.
Jason, how about you? Anything kind of in wrapping up as far as from a capital markets perspective? I'm going to steal the lock early and lock often thing. I'm going to use that moving forward a lot. I love that tag phrase, but thoughts from your perspective?
Yeah, I think just don't get discouraged, right? Along the same lines. I mean, people need shelter, right? So either they're moving up, they're moving down, they're forming families. Houses are going to be bought and sold. The world will keep turning around. Don't get caught up in the here and now, because it will get better and things will level off here. And we're still in a good environment. And I think there's, we do have a inventory issue, but kind of going back to our earlier discussion there, I think there's a shadow inventory, right? I think there's a lot of folks that we saw departing residences not being sold at a higher level than ever, right? Because they made all this money in the stock market. They're maybe retiring early. They went and bought another house downsized, and they're like, well, I'm going to rent this one out and ride the HPA up a little bit. So we could have some of that shadow inventory coming in. I think the issue that Brandon brought up about these private equity guys or corporations buying,
That's real.
homes,
That's real, right?
That's going to have to be addressed in some form or fashion. That's becoming an issue. I don't know what the percentage of purchases it was last year or this last quarter, but it's a big number. And that's really hurting your low to moderate income folks and your first time home buyers, right? So that the lower spectrum of the UPVs are where that's happening. And, there's all kinds of stats out there. You can make up stats, but one of the stats I read, I can't remember who it was, if it was the NBA or somebody, but it's like 5 million people are turning 30 years old over the next 5 years, right? So, and that's your pivotal family formation years, right? So there's going to be a lot of opportunity to do business here. I think you just got to maintain focus and just realize what we're in, right? We're in a purchase cash out environment.
That's right. And you know what, Jason? I'm going to ask you one more question in passing, because he just brought up something that I wanted to ask you. It was one of my questions, but I've been reading so many articles about the number of transactions on the purchase side during the pandemic that took place. And you actually mentioned it, which were all cash offers, right? All cash purchases. I mean, there's some county I read in Atlanta where it was like 90% of the homes that sold in the fourth quarter were cash transactions. Do you guys track? Do you have any statistical insight on that? It seems to me like the last 2 years would be some of the highest levels of cash transactions that we've seen from a purchase perspective, but I could be off on that.
That is actually not something that we track. We're with our consortium base is based on the loans that they actually do, not the cash transactions that happen. But 90% would seem extremely high,
right?
But I do know that there was a significant increase in all cash transactions in the space.
Yeah, it seems to be just doing it informal, like Brad. That we work with Brad Clada, like he says, when he's at Home Depot, he takes a poll. But it seems like there is some slowdowns talking to people. I'm out in California this week, and it's kind of funny, but it seems like it's a little bit of an indicator. Like somebody said, well, my friend's house took a week to sell, right? So
Right.
it didn't sell within 24 hours with 10 offers. It took a week and it sold at list. So I think that's, there's indications that things are cooling off, and it has to, right? We can't keep going at this pace. So
That's right.
We'll see that calm down, and I think that'll subside. But historically, there's always, I don't know the exact number. It's a decent size of cash purchases, 25% or something like that. Maybe we hit a third or 40% during the pandemic, but it's always been a decent number.
Well, I just think that for the business partners on the other end, right? You guys have done a good job describing, don't panic, stay the course. There's opportunity. It's a purchase market. Affordability is still there. Rates are historically still low. ARMs will become an outlet. There'll be more product expansion. Cash out refinances are still there because insert life event, right? Whatever it may be. But the all cash purchase is one to me that if I were on the other end, originating and staying in touch with borrowers, I look at that as an opportunity, right? Because the market's doing what it's doing. Wealth from investment perspective, depending on who you are and what you're invested in, you're seeing that hit dramatically potentially. So the creation of wealth and the retention of wealth. Now I paid $1 million all cash for a home. That is equity that's sitting there untapped. And to your point, HELOC may be a great opportunity, but a cash out refinance, pulling out $500,000-600,000 cash, that exists still. So I brought that up because I think there's just a tremendous opportunity. And to both your points, like the media, what you read in print and what you see on TV, I mean, they get it wrong more than they get it right. I almost liken it, when our industry is concerned, I liken it to being a weather person. It's the greatest job in the world. You get paid to be wrong 90% of the time, but you give your opinion, right?
Right.
So what I call is like, don't get caught up in the soup, right? Like, don't get caught up in the mix of all these projections, prostications, and everything like that. But guys, I can't appreciate you doing enough. What's that?
Even if a borrower does take an ARM right now, there could be an option to refi to a fix, right?
That's right.
We used to say, rearm, disarm, right? Like
that's right.
Take advantage of the opportunities that you have right now, and odds are there will be another opportunity to do something later, or like we talked about, try to figure out how long you're going to be in that home and choose the product, accordingly.
That's right. Well, guys, hey, I can't thank you enough. Sorry for some of the live technical issues that we had getting going, some noise in the background, but I think we got through it. I appreciate, Brandon, you coming on board and doing this with us. Jason, always great to hear from you. A lot of valuable insight for our business partners. So can't thank you enough for doing this.
Yeah, no, thanks for the invite, John.
Thanks for having me.
Absolutely. Thanks, guys.
All right. See you guys.
All right, gang. Hey, I know we ran over a little bit there, but I thought there was some really good content. I wanted to keep going because we got a bunch of questions. If we didn't get to all the questions, we'll get back to you. And look, I think it was a good segue because in June, our Flex series, our friends over at MGIC are coming on board. Kevin Herndon, who's the Director of Product Development at MGIC, again, second Thursday every month, 2 p.m. Eastern, he's coming on board. And he's going to do a deeper dive into ARMs and the ARM market, not necessarily from the perspective of a capital markets function or what Jason and Brandon were talking about today, but more about the nuts and bolts, like, ARM, the DNA of an ARM, not just right or left, but like what makes up an ARM, what makes your qualifying rate, the basics of it, the affordability, and then really go into, the kind of why should a borrower consider an ARM? So when you're talking to your potential borrower or your borrower from the past, and you want to approach the topic of an ARM, how do you do that, right? How do you have the conversation with them of the fixed versus ARM analysis? Why is it more beneficial to take an ARM? When is it more beneficial to take an ARM? So we're going to dive into all that in our series in June in a couple of weeks. But as always, can't thank you enough for joining us today, and certainly can't thank you enough for being a partner with Flagstar. We certainly appreciate you, and we appreciate our partnership. So hopefully it's brought some value. And with that being said, we will sign off until our June series. Make it a great day.